Welcome back to A Stitch in Tax, Saves Cash. Today, we're breaking down one of the most important provisions in Nigerian tax law, Section 3 of the Nigeria Tax Act, 2025. This section is the legal backbone of how income tax is imposed in Nigeria. Whether you're a business owner, an employee, a consultant, a trustee, or a professional advisor, this is something you absolutely must understand. Let's get right into it. So, why does Section 3 matter so much? It's simple. Taxation only happens when the law says it does, and Section 3 is that law. It clearly states that tax is imposed on the profits or gains of companies or enterprises, the income of individuals or families, and the income that arises or accrues to trustees or estates. This single, powerful statement defines exactly who is taxable and what kind of income falls into the Nigerian tax net. Nigeria's courts have consistently backed this up, saying that a tax must be clearly stated in law. There are no assumptions and no implications. A perfect example of this is the Court of Appeal's decision in FBR versus Halliburton, which held that charging provisions like this must be interpreted strictly. No ambiguity allowed. Let's first talk about companies and enterprises, which form the corporate tax base. Section 3 makes it crystal clear that every company or enterprise earning profits from Nigeria is taxable. This includes Nigerian companies, foreign companies that earn income from Nigeria, joint ventures, partnerships, and even other unincorporated businesses. The landmark case here is Shell versus FBR, where the Supreme Court decided that profits from Nigerian operations are taxable, no matter where the payments are actually made. The bottom line is, if the income has a Nigerian connection, or a Nigerian nexus, it's within the scope of the law. Now, let's move on to individuals and families and what this means for personal income tax. The law also covers individuals and families, which includes employees, sole proprietors, and entrepreneurs. You might be wondering, why mention families specifically? This is because some Nigerian customary practices involve pooling income or assets under a family structure. The law cleverly closes this potential loophole by ensuring that any income generated this way remains taxable. So, whether you earn your money from employment, your own business, investments, or any other lawful source, Section 3 applies directly to you. What about trustees and estates? Does fiduciary income get a free pass? Absolutely not. Section 3 also brings into the tax net any income held by trustees and any income that accrues to an estate while it is being administered. The courts reinforced this in the case of FBR versus Integrated Data Services Limited, stating that income is taxed based on its substance, not the form in which it's held. So, if money is being earned, even if it's under a trust, it must be taxed before it's distributed to any beneficiaries. The tax authority gets its share first. To really get a grip on this, there are 4 key legal principles you must know that courts follow when they interpret Section 3. First is clarity and certainty. The law is king. Only what the law expressly says can be taxed. Second is strict interpretation. This is a big one for taxpayers. Any ambiguity or confusion in a tax charge is always resolved in favor of the taxpayer, not the tax authority. Third is the territorial nexus. The income must have a Nigerian source or a clear connection to Nigeria to be taxed here. And fourth is broad application. Once an income stream fits into any category under Section 3, it is taxable, unless another part of the law specifically exempts it. These principles are crucial because they protect both taxpayers from unfair charges and tax authorities from arbitrary interpretations. Now, you might think this is unique to Nigeria, but it's not. If we look internationally, Nigeria's structure is quite standard. The UK taxes companies, individuals, and trustees. The United States taxes individuals, corporations, estates, and trusts. What makes Nigeria's law unique is the explicit reference to family income, which shows a deep understanding of our local socioeconomic realities and customs. It's a great example of global standards being adapted to local contexts. So, what are the practical implications for everyone? Let's break it down. For companies, You must ensure that all profits attributable to your Nigerian operations are properly documented and declared. For individuals and families, remember that no income can be hidden under communal or family arrangements to avoid tax. The law sees through that. For trustees and executors, you have a legal responsibility. You must pay the tax on any trust or estate income before you distribute it to the beneficiaries. And for the tax authorities, this is a reminder that all administrative actions must follow clear statutory authority. The courts will strike down any overreach, as we saw in the 2025 decision that invalidated the FIRS CBCR regulation in the case of FIRS versus Checkpoint Software. To wrap things up, Section 3 of the Nigeria Tax Act, 2025 is the very foundation of our income tax system. It ensures that companies, individuals, families, trustees, and estates all contribute their fair share to our national revenue. And this is the important part, only in ways that are expressly allowed by law. It perfectly balances the critical goals, preventing income from escaping taxation while protecting taxpayers from unlawful or arbitrary assessments. And that, right there, is the hallmark of a sound and fair tax system. Thank you for watching today's breakdown. I'm Olatunji Abdulrazak, CNA, ACTI, ACARB UK, founder and CEO of TaxMobile Online. If you found this helpful and want to stay ahead of the curve, make sure you subscribe for more expert insights on Nigeria's constantly evolving tax landscape. Thanks for watching.